In a few hours, we will know. The MPC will decide live on CNBC Africa whether it's going to cut interest rates for the first time since March 2018. Some economists are predicting a 25 basis point cut to bring the repo rate down to 6.5%. What are the chances for a bit of relief for the indebted who, according to a recent report, are getting more and more? Well, I'm joined by more for this pre-MPC discussion in the studio by Transaction Capital CEO David Hurwitz and via Skype also by economist Tumisho Grater, economic strategist at Novare in Cape Town. Thank you very much for both joining us. If I can start with you, David. You just put out a report here, and it's a very depressing read on hopefully a day of hope where we are going to get an interest rate cut. But you're saying that there's no improvement at all in the rehabilitation of debts in this country.
Yes, so Transaction Capital has been issuing a report now for about 2 years. It's called the Consumer Credit Rehabilitation Index, which basically measures if a consumer is able to recover from their debt position. It's not a survey, it's statistically based. There are 38 million South Africans, 24 million in credit who are credit active, and about 10 million in distress. And we've got a sample of about 15 million South Africans. We believe we cover the full 10 million of distressed consumers. And we take a sample of half of that database, half of the 10 million, about 5 million individuals in South Africa who we have data on, and we score their ability to repay their debts. And it's been at a very low level for the last 2 years, and it's deteriorated over the last 2 years or so.
And you say 10 million in distress. I mean, that's like 1.5 times the size of the population of Johannesburg. It's incredible.
It's 40% of the credit active population. So it is a very high level. And you know, all of the factors that we look at are negative. Things like our unemployment rate sitting at about 27%. Things like household debt to income sitting at about 73%. The cost of living is expensive, fuel prices are high, electricity prices are high. So most of the factors that we actually look at, and wage growth is low. So most of the factors that we look at are negatives at the moment. There are only, I think, probably two positives. The one is that inflation is well managed, right? You know, bang in the middle of the target, instead, you know, targeting 3 to 6, and we're sitting at about 4.5. And the other one, maybe I shouldn't say it's positive, I'm hoping it's a positive, is I'm hoping for a rate cut today of 25 basis points.
Now on a more optimistic note, we go live now to Cape Town as well, to Tumisho Grater, the economist who's joining us. Tumisho, seems that most economists agree we are going to get a cut today. Are you one of them?
I think it's going to be a very fine line, but at the end, Chris, I do think there is definitely scope for the South African Reserve Bank to cut interest rates. Listening to what David was saying around the inflation range of 3 to 6 and us coming in smack bam in the middle, the inflation numbers that have come out for the past 6 months have shown that, you know, we have been within that target. Another thing has been the global backdrop. It's been very, you know, it's quite supportive and giving the South African Reserve Bank the space to cut interest rates, because we see in the likes of the, you know, US Federal Reserve hinting at the prospect of, you know, possibly cutting interest rates because of the global growth environment. So it's going to be a tough one to see if they will go ahead with that 25 bips cut. You know, just maybe thinking about other things in the future, more specifically the medium-term budget policy statement, which may prove to be one of the hurdles that the SARB will be keeping a close eye on. But as far as things stand for today, we're leaning more towards a 25 basis point cut.
Okay. Well, earlier in the show, I was speaking to Gary Boyson, the analyst here, and he was saying hopefully 25, but hopefully 50. How likely is that?
I think, you know, if you want to look at the impact that more aggressive cuts would have to the South African consumer, actually it would be more beneficial. But again, I must stress that we also do have the credit rating risk. I spoke about the medium-term budget policy statement, and one of the things that we'll look at is the extent of the fiscal slippage. So if we see that we are seeing a further deterioration in where we stand in terms of our debt to GDP ratio, credit rating agency Moody's, which is the only one that currently holds us at investment grade, it's a big risk in terms of our rand, our inflation expectations. So I think being very aggressive right now may not, I think the SARB may err on the side of caution. I'm going to be a bit less optimistic and say 25 basis points. I'm not really looking at 50, although 50 would be great.
Sure, absolutely. Well, we'd all agree with that one. But coming back to you in the studio, David, I mean, one thing that I don't get about this inflation story is between the band they're looking for the 3 to 6%. But I mean, to my view, the amount of can we say distress is, I think, is the word you use, that people have at the moment. If you go, the shops are closing down everywhere. Demand everywhere that are open seems a lot emptier. I mean, surely we should be even further down in inflation terms than we already are.
So, I mean, everybody would like to be there, more towards the bottom end of that range, and we've been in the middle of this range for a long period of time. There are some real pressures, as I said, things like the fuel price, things like electricity prices, and these are things which are creating real pressure from an inflationary perspective. And the issue is wage growth just hasn't, growth in general hasn't been high enough. GDP we all know about, which has really come down. The general view is it's going to be below 1%, and looking at that point around the credit rating, I know Moody's have got it penciled in at 1%. Most are saying it's going to be below, so that does create downgrade pressure. But we need growth. We need GDP growth. We need wage growth, and these are the type of things that are really putting pressure on the economy. And to try and get some type of consumer-driven rehabilitation, economic rehabilitation, is difficult. The one very confusing thing that I see when you talk about shops closing down is if you take a look at the National Credit Regulator statistics, we see that both banks and credit retailers have actually expanded their credit extension, which I can't really understand. If I look at everything, the consumer's under pressure, but banks and retailers seem to be lending more at about retailers as high as 9%, as banks into the consumer segment as high as 10%. So that is a little bit confusing as well around kind of sales and credit growth.
But isn't it a case of these interest rates? It's a good way to make money for the banks.
The only way to make money, yes.
At the moment. But Tumisho, just to go back to you, I mean, you talked about a risk there. The rating agencies are still looking at the growth opportunities and the growth progress for South Africa as they make their decisions in the future. Is 25 basis points enough to stimulate any kind of growth to maybe get us over 1%?
I don't think one interest rate cut of 25 basis points is enough to get us out of the situation that we're in. Remember, a lot of the things are quite structural, and I do think it cannot be the responsibility of just monetary policy to get us out of here. We do need a combination of fiscal and monetary policy to come together. So if you remember last year, I think it was in February, the National Treasury actually tabled and tried to quantify specific sectors and specific things that the government could do in order to boost economic growth. So some of the things that they looked at was, for example, business confidence. So this would to ensure that we've got credible policies where there's continuity. So they said things like business confidence could add as much as a 0.5 percentage point to GDP. It doesn't sound like a lot, but when we are sitting, with a contraction of 3.2%, and when economic growth is said to come in around the 1% region, just the 0.5% more would make a huge difference. Other things are other sectors like the telecoms, agriculture, and so forth. So there are practical things that we could do to get us there, and I don't think that monetary policy is the answer to it.
Well, I'm sure a lot of people are asking you at the moment, in these very bleak and gloomy times for the economy, what do you think some of the factors that could be a way out of it?
Maybe just clarify for me, Chris, some of the factors out of?
Sorry, the way to this elusive growth that South Africa is looking for.
Yeah. So again, just highlighting just some of those factors that we could be looking at. So if we maybe zoom into business confidence, which I've mentioned, again, it's about having those credible policies in place. So ensuring that there is further certainty around, say, the issue around land expropriation, so we can see investment coming in to the agricultural sector, the property sector, whatever the case may be. I think some of the more positive moves that we've seen is the reappointment of the South African Reserve Bank governor and the appointment of the two deputies. That actually just says there's going to be continuity of monetary policy. So from that standpoint, that was well received. So continuing to do the right things that are going to give the investor community the confidence to say, okay, we know if we put our money into South Africa, we know what's going to happen in terms of those policies. So it's really just those small things. So I think boosting confidence is the cheapest form of stimulus, really.
And David, just come back to you in the studio here. It's one of my theories, sorry, that the only way out of it is a lot of economic pain, a lot more economic pain, other than being one of the 10 million distressed and indebted in this country. I think that there needs to be a lot more sacrifice. We're talking about lower wages. We're talking about less disposable income in the future. How likely do you think the economy has got the rectitude to bring that about?
Yeah, so I mean, first of all, I agree with you. This is it's a slow process. I've actually just come back from an international trip where in the UK and the US, and most of the investors looking to invest into the country were saying post the elections now, very happy with the result, but they all believe that the recovery will take longer than expected. And the hope was really to see how strong President Ramaphosa was. If he could make bigger changes to cabinet, it would have been a quicker recovery. Now, based on what's happened, they are expecting a longer recovery. So I always come back to the consumer. The consumer only really has one way out, and that's a slow deleverage of himself. If you take a look over the last 5 years, household debt to income's gone from 77% down to about 73%. So that is happening, but it's really slow. And ultimately, if you take a look at the three balance sheets in the country, you have business, you have government, and you have consumer. And the only balance sheet in decent shape is business, which comes back to the point that we've just made on the show, is that you need to get business confidence, both internationally and, more importantly, in my view, local as well, to start investing back in the country. Corporates are sitting on too much cash. We need investment and we need growth.
Because that's one of the issues that one of the analysts raised earlier in the show, and the fact that he claimed there was more interest from people outside the country wanting to put money in, rather than domestic companies here who have got vested interests here. What do you think could shift these corporate companies sitting on cash here to put their money back, plough their money into this economy?
I think exactly as we've just said, I think you need certainty around policy. And I also think we need to rebuild trust between corporate and government. And there have been terrible examples on both sides where corporates have behaved badly and government maybe hasn't been as embracing as they could have been around business. And it's quite a bad space at the moment if you take a look at some of the failures that we've seen on both sides. So I would hope we really just need confidence and trust to be built, and that comes through line of sight on policy both ways.
So just a last word from you, Tumisho Grater, coming to us live from Cape Town. Perhaps you could leave us just with a little bit of hope and look into the future and this interview ahead of the big MPC interest rate decision in a couple of hours' time.
Again, I think in terms of hope, we are in a better position now than we would be in, say, a September, because we would be very much ahead of the medium-term budget policy statement, and I think there'd be a lot more nervousness around that. So given the fact that we've got other big central banks saying we are going to be a bit more accommodative, that is definitely giving us the space to take action now. So going to hold cross toes and thumbs that we do get at least a 25 basis point cut, but again, it's going to have to be a collective effort from a both monetary and fiscal standpoint in order to get South Africa out of the ruts that it's in at the moment.
Okay, well, thank you very much indeed, Tumisho Grater, the economic strategist at Novare, live to us from Cape Town. Thank you also, David Hurwitz here with Transaction Capital.